Hello everybody, Michael Silva here. I got a wild and crazy episode today in the Stock Market Brief Show. Got a lot to discuss. We're going to talk about the price action in the SPY, but then we're going to give you some macroeconomic data and just show you how strapped the consumer is and why that's actually incredibly important. There's a lot of opportunities that come out of recessions, if that's what we're going to be walking into. So we need to make sure we preserve our capital, we grow our capital, and we manage all that risk there in between. Well, that's what we're going to talk about on today's Stock Market Brief, everybody. Let's get into it. Hello and welcome back. We're going to start looking at the SPY on the daily time frame. We got beneath that quarter to date anchored VWAP that we discussed right over there. And then today we gapped up through it, creating a abandoned baby, a bullish abandoned baby. Don't ask me why they named it this, where we have some weakness here and then we gap right back up. Now, it really depends on what time frame you look at, because if you look at like a 15-minute time frame, notice how we came back in within the weekly expected move, bumped our head around the daily expected move. You can't tell me these levels don't matter. And then we kind of just doodled and we closed on the daily expected move. So if you look at this at a 15-minute time frame, this is not called abandoned baby. It's called an island reversal. Woo! There's bullish ones and there are bearish island type reversals, which are, once again, reversal type patterns. So does this telling us that, hey, if we can hold the this quarter to date anchored VWAP, does that keep the door open to go hit the all-time high here in 2023? Not all-time high, but the 2023 high, and potentially fill this gap in the one above it. I think the cards are on the table still, so that hand is still in play. However, if you just look at ES, what are we doing? Well, we're really just still pinned between this zone that we've been talking about for, I don't know, since the beginning of April, as we've had all kinds of crazy bullish sentiment here, then all of a sudden bearish sentiment, and bullish again, and then even back to bearish, but we're really just sideways. Here's some important levels to keep on your chart we discussed. This is Bookmap. Bookmap allows you to see behind the candlestick, so I zoomed way out, and this level has been here, two levels that I want you to get on your screen because I think that they're going to be coming into play in the near future because they've been there, and these levels of liquidity, they can act like magnets, and eventually price will kind of make its way to that supply, both either from the upside or this the bids to the downside. So those two levels that I want you to pay attention to from a longer term perspective is 4250 and 4000. If I zoom in on Bookmap, and I'll tell you why Bookmap is so important here momentarily. I'll share with you one of the trades that I took today. So if I take a look at ES, right, so you can see here, the market closed right here is pretty much a choppy type of day, up slightly, but we have some orders of liquidity coming in, as you can see. So these levels will be important to watch going into tomorrow. But let's take it one more step. We're going to look at the daily expected moves for tomorrow. 4127, that's right about here at this area of liquidity. You can see it's kind of highlighted right here, right at around 4130, and then 4190, which is right up in here. And you can see that there is this order of liquidity out there. So these are going to be key levels to watch going into tomorrow's trading session. Why is Bookmap actually some incredible software? I want to show you something. So this is the candlestick chart of NVIDIA, right? NVIDIA had earnings. And, well, it was crazy, right? So if you were caught short, that's really unfortunate. If you played it intraday, you may have seen this 5-minute time frame consolidation. We broke out, and then we started to flag and consolidate again. If I pulled up Bookmap at that exact time, what you can see here is you see all of these orders of liquidity. And what you see is you see some nice volume, boom, nice volume, boom, nice volume, and you see price making a series of higher lows and getting hit at that bigger order block of liquidity. And then price started pulling back down and did what? A higher low, pulled back down, another higher low, came back up, pulled back down, another higher low. So this right here, I call this the buy stop pop. So you basically, put a buy stop order right above this order of liquidity, because if we get above it and it breaks, there could be breakout traders, there could be people covering their shorts, and you can get a potential pop into other areas of liquidity. And being as how this was a very active stock today, what took place? Well, we started to break out. So if you take that trade, starts moving up, you notice that above us, there's even another bigger order block, but that's $5 a big, ahead of us. And we have some smaller orders at 92, 93, 94, but the big one was at 95. So you see this thing, and boom, it started breaking out of the candlestick. But if all you're doing is looking at a candlestick, you don't get to see all of that data. Or you can look at level 2s, but I find level 2s incredibly difficult for my pea brain to like keep track of. So I love looking at the visual. Now, what took place? Look at it, broke out, came into this order of liquidity and was rejected at 395, and it got pushed right back from it. So this is why it's important to know, because you could have taken profits here, some here, and so forth, making about a $5 per share gain on the highest end. I didn't get $5 per share, but on average, I think it ended up being like $250 total or something like that, which was plenty for the position that I was doing. Bookmap, they offer a discount to any of my subscribers. I have a link down there in the description below. It's what I use every single day. Let's look at SPY on the 15-minute time frame. Now, I overlaid some stuff. I overlaid the new daily expected moves for the SPY, 411.20 to the downside, 418.10 to the upside. As it stands right now, we're trading within the weekly expected move. Remember, 68% of the time, one standard deviation finishes within those weekly expected moves. Okay, we got rejected at the 5-day moving average. So to be more bullish, you want to see price recover that level. Okay, now as it stands, you might be able to look at this from a technical perspective, and you're like, yeah, we're kind of potentially creating a wedge, potentially a bear flag of sorts, something like this, and that could open the door to come right back down to potentially hit the lower expected move, or potentially even further if it's a full measured move. Now, I want to pay close attention to something. Going into tomorrow, there's going to be some key areas of support. Okay, so first and foremost, the big one that I want to see hold is going to be obviously the weekly lower expected move. But not only that, that's in confluence with the month to date anchored VWAP, which held as support today in confluence with this. And then on top of that, it's in confluence now with the low of today's trading day. So you have the low of the date trading day, right, which actually matches up with the prior, kind of gap high right over here. Okay, so we gapped above it, came back down, it acted as support, and then we kind of push right from it. So if this starts breaking, just be careful in that regard, because we could come very quickly down to fill the gap, which is right here, the gap, and come tag this lower daily expected move. If that is the case, you can potentially play a U-turn trade, boom, and play it back up intraday to the weekly expected move, which will be in confluence with the month-to-date anchored VWAP. So obviously, we're below the week-to-date, we're below the 5-day, so you need to proceed with obviously caution. We discussed this and we've laid this out on a prior video where you see a high, boom, and you see the lower high. So now if it starts taking out this prior swing low, if you're a little bit more aggressive, it could potentially break right down to there. So keep in mind that the bulls on the shorter time frame have work to do. On the daily time frame, we're above that quarter to date. So it's on the longer term, hey, we're bullish until we break those levels. Okay. So I hope you guys get some insight. Let's hop into the consumer stuff. So the US consumer makes up for 68.35% of the GDP. Personal spending, right? Personal consumption. So that's a huge part of GDP. So if there's something wrong, obviously, with the consumer, if the consumers are feeling the pinch, what happens? Well, GDP can contract. And when GDP goes negative, when we have technically, right, we keep on changing the definition of recession. When we have 2 quarters of negative GDP growth, we're technically in a recession. Okay? Now, if I take a look here at XRT, this is a retail ETF. Retail ETF. Understand that retail is driven by the consumer. All right, so if I look at how is this chart doing and how does it reflect the consumer, well, since 2022, I'd say, well, not great. Because if we're looking at like AI stocks and the mega cap stocks, right, the Qs, everything looks great. But when you really take a look at, hey, okay, so how's retail doing? How's the Russell 2000 doing, which is a good barometer of the economy? Not that hot. It looks the same. So we'll go back to this one. You can see this is a weekly time frame. We broke out, we consolidated, we came back down, and now we're consolidating again. Now, I want to call out a couple of things. We're below the 10-week and the 40-week moving average. That's the 50-day, 200-day if you're looking at a daily chart. And we have this gap right here. And the gap I'm showing you because we had most volume traded here on this 5-year chart. And then we have prior area of resistance, and then we had the most volume traded in this area. So we have this kind of big volume gap, which means if price starts really breaking down, it could be a quick hit to the pre-COVID crash high. Okay, and that could very well play out. Now, you can look at this and be like, well, price is right here. I think we're going to recover. And then you can be like, okay, well, I want to go long right here, have a stop, and then maybe play it to the upside. That's always a possibility too. I'm not trying to make a prediction. I'm just showing you that, hey, chart has a high, lower high, lower high, lower highs right now, okay, in bearish context, which is not a good look overall. Now, when is the best time to buy retail? Now, this is one of the charts that I shared on Twitter, and this one's crazy to me. Okay, so I'm looking back as much as I can on the weekly time frame. This is dating back to 2006. Okay, and I applied the Fed funds rate. So this just should open your mind here, okay, on how you should not act as a consumer. All right, and what you typically you should be doing the opposite of what most people do as far as savings, investing, and so forth. So when I look at this chart, when you see the Fed funds rate go up, what does that mean? Well, it means that there's typically less spending, less frivolous things taking place. When the Fed funds rate gets slammed down to zero, well, money's a lot cheaper, right? It doesn't encourage savings. It encourages buying things because things present themselves as cheaper because, well, credit is cheaper. So if I just look at how does the consumer act in certain periods? Well, in certain periods when there's a tightening cycle and we pause, the consumer, well, it doesn't look too hot. This is the great financial crisis, right? And then we have to smash rates back down to zero. So what happened when we're back down to zero? When the the tightening cycle is over and it's an easing cycle begins, basically. Boom. We move up quite a bit. Okay, well, then the tightening cycle starts over here again. We go straight up. Well, what's happening? Well, tightening cycle begins, and we don't go anywhere as a consumer in this retail section, a retail spider ETF, for 1, 2, 3, 4, 5 years, really. And then what? We slam rates back down to zero. And what happens? Boom. We take off like a rocket ship. Okay, well, we start to raise rates back up at a very rapid rate. What's happening? Hurts the consumer. Now, what's crazy to me is the consumer is already down pretty significantly, and we actually haven't went through the easing cycle yet, slamming rates back down. Now, we might not go back down to zero. I don't know where we're going to go as far as rates go, but as it stands right now, we are not even talking about bringing rates down. The Fed's saying the base case, they're going to keep rates higher for longer, and I'll show you that chart momentarily, okay? Higher for longer to bring inflation down. So to me, when I look at this, I'm like, oh gosh, careful in retail world, right? Consumer seems pinched. So if consumer's pinched, GDP starts backing off, yeah, it's just almost like clear signs, right? If you take a look at IWM, it's the same thing. It looks pretty weak. So somebody has to step in. If you like, high risk to reward, you might be like, okay, well, we tagged here, we gap there, now we're holding a support. Yeah, maybe we come flush down, scare some people, you turn back up, and then we start moving higher. Okay, that's always a possibility. It always is a possibility. But also, if that's a possibility, this is a possibility to slam back down. Okay, what's taking place on the balance sheet of the Fed? Well, we're still reducing. So remember, liquidity out, right? Liquidity was out. We came up, banking crisis, liquidity back out. All right, when this happened, everyone's like, we're back, baby. Okay, well, now we're not again. If we take a look at this, liabilities and capital, this is other factors draining the reserve balances. So just think of this as a liquidity chart as well. It's the blue line. All right, so the S&P 500 has been going up. Liquidity has been coming out a little bit up, and then we just got our most recent report, and it was drained a little bit. Now let's layer on some more macro data. This is crazy. Delinquencies. These are serious delinquencies, 90 plus days. This isn't like, hey, I forgot to make my payment. This is like, hey, I forgot to make my payment for the last 90 days. No, it's I'm not making my payment because, well, it's too expensive. Now, I'm not even going to show you the credit card interest rates, which are at like all-time highs. Well, I don't know about all-time highs, but they're at a very high level that we haven't seen for a long time. This is 2008, 2009 or whatever, when we started seeing massive delinquencies that happen to be also obviously in the mortgages, right? But if you take a look at like, where's the autos? The autos were doing kind of a similar type situation there too. What are we doing right now? So delinquencies, boom, they're on the rise. And this is a pretty rapid rate of change to the upside these last couple of reports. Boom. So credit card delinquencies, massive delinquencies are going up because of interest rates. They're going up. Makes it harder to service that. We're seeing retail sectors get hit. And why? Well, we talked about the Fed interest rates already. It's a lot harder to pay balances when interest rate, it encourages savings. And if you spent a lot of time going crazy and buying down here, and then they just pull this out of nowhere, well, it's a rude awakening. But take a look here. Student loans. Wow, whoa, delinquencies came way off. Yeah, well, because of the whole forbearance thing or whatever it's called, where basically you don't need to pay your loan, right? They're making it so students do not need to pay right now. And that's really to help out during this whole pandemic thing. But they're slammed down. But if you pay attention, what's happening? Well, we're about to make it where they're kind of off the hook for that, or they're not off the hook. So the payments are coming up right around the corner. So this is an article that shows that the forbearance could end sooner if the Supreme Court decides the fate of President Biden's plan to cancel. We're looking at around late summer. So students may be off the hook for payments around late summer of 2023. Okay, that's right around the corner. It's May right now. So what, like the end of June? Obviously policies can change, new things can take place, but be aware that we're already having serious delinquencies here in credit cards. Auto loans are starting to uptick. Student loans are obviously flat, but now if all of a sudden student loans start coming into play, what about, what's that going to make it look like for credit card debt and auto loan? It's not going to be good for the overall consumer. I'm sorry. This is just reality. I'm try to find a bullish case in this. I just can't right now. It's dangerous, and we need to just be aware of it, because if you have credit card debt, that should be one of your main focuses. Just getting it off, getting out of your hair. Just get rid of it, pay it off, and protect. You don't need to worry so much about all the economy around you. Worry about your specific economy, your household economy, your four walls is what like Dave Ramsey says, right? Where it's like utilities, housing, whatever, auto, and something else. I forget. Okay. Let's wrap this up too on credit growth. Credit growth is seeing it contract. So not only has there been a tightening cycle with the Fed, now we're starting to see banks tighten the reins on easy money, I guess you can say, right? So the rate of change here is starting to come down. And now every time we've had a recession, there was a decline in credit growth, or the rate of change of credit growth. You can see, like the gray shaded areas, we saw credit growth go down right before, boom, a little bit of credit growth go down, boom, credit growth go down, 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 okay? Doesn't mean that there's going to be a recession, but there are a lot of things lining up saying, hey, watch it. And we're starting to see that decline now too. Oh, man, it's crazy. Cool data. It is cool data. Like I said, it's all going to be obvious in hindsight if something bad happens. I keep on saying that. If we take a look at the Fed Watch tool, now, what do you know? There's a higher probability of a rate hike in June than there is for keeping it flat, right? So that changed just today. 1 month ago, there was only an 8% probability of a rate hike. Then there was a 35% a week ago. 1 day ago, there was a 36% chance. And now we're up to 51%. So it's still a coin flip, but now the odds are going for a rate hike. And you can see they're holding it there, 525 to 550 for higher. So the Fed's not done, is what this is trying to tell us, at least the futures, Fed Fund futures is. And while this is taking place, the yield curve is inverting deeper today. 67 basis points, that's to the 10 and 2. 10-year and 3-month is 155 basis points, that's rather flat. You can see these yields, look at these things, flying right now. It's actually pretty crazy to me to see the Qs going up while the yield's going up. But there's a lot of markets that are, getting suffocated right now. And you can see the 10-year yield, if this is a bull flag, holy moly, that'd be crazy. That means bonds, they still have ways to go down if that's actually the case. So this thing has been moving fast. And what's crazy about this is if you take a look at the 10-year on the weekly time frame and you look at the relative performance of tech and then consumer discretionary, typically when you get a rapid rate of change to the upside in something like the 10-year yield, you typically get underperformance in technology. That's typical because, well, rates are more, kind of suffocates growth a little bit because these are heavy growthy names, and you typically see the relative performance die out. And same with discretionary. Boom, you see it go down. Okay, when this goes down, oh, that's kind of good for the relative performance. What do you know? It's kind of good for the relative performance. This goes back up. Let's go down. No. Okay, but what's crazy here is take a look at this rapid move. Now, it's a few stocks. This one's kind of not doing much, flat, but we're starting to see this uptick. At the same time, now that correlation, those don't typically last too long, but it is something to just be aware of, because if you're looking at like, hey, smart money versus dumb money, my money's typically on the bond market, is where, where the smart money actually is. Now, if we look at the dollar's also busting out like right now. Absolutely massive monster move, which is putting pressure on silver. It's putting pressure on gold. It's putting pressure now on the S&P 500 slightly, and various other assets and commodities. So this is, it's getting frothy. Who knows? Who knows what's trying to price in, right? We talked about credit default swaps being at, backing up but being at highs. There's just a lot of things going on now, and it's very hard to just be like, yeah, let's go all in right now. Yeah, why not? Because it's price action. It's bullish, right? Kachinga. Now, if we take a look at the NYSE summation index. NYSE summation index is still pointing down below that parabolic SAR. Same with the Nasdaq McClellan oscillator. Not an overextended reading by any means, but this was looking like it was going to flip over. It did not. And then also the trend line that we were watching here on the advanced decline for the New York Stock Exchange broke down. And we were watching that very carefully because that, it's held as a very solid area of support, and it was helping move this up. But now we're starting to see that weakness come in. So if this does start breaking down further, it could indicate that we have more weakness there in that broad market. If you take a look at something like the Nasdaq summation index, we did have that tick over. We saw the market move higher, so that's positive as a potential change in trend. We're really just going flat, but I will say this is starting to kind of hook itself over there. And even despite today's up day, take a look at breadth on the Nasdaq McClellan oscillator. Boom, it's down. So, obviously few names helped. What names helped? Well, those obviously the what are they called? Semiconductors. Nasdaq 100. This is a cool chart. Percent of stocks above the 50-day. Percent of stocks above the 200-day. In short, what does this mean? It means 47 means 47% of the stocks are above the 50-day. 63% of stocks are above the 200-day. Nasdaq 100. Boom. Right? A new 52-week high over here. Where are we on new 52-week highs for percent of stocks above the 50-day? Well, we're actually declining, which tells me what? It means more stocks are breaking down than actually going up to help the Nasdaq 100. Same thing with the 200, right? After this strong move, we have less stocks above the 200-day moving average than we did prior to that move. So it's a divergence. They can be bullish divergences that create movements to the upside. They can also be bearish divergences that, hey, don't do anything, or they play out to the downside. You can see the advanced decline line here too as well. We're pressing higher in the Qs. Or I should have propped up the Nasdaq composite, but it'd be pretty similar. And we have negative divergence there as far as breadth goes. And you can see at the same time, we're pulling off in the percent of stocks on buy signals based off of point and figure charts as the market's moving higher. But we're not, from an RSI perspective, overbought or oversold at this particular time. If we take a look at equal weight Qs versus just the Qs, right, being cap weighted. Well, it's a negative divergence, right? So, and this is actually kind of interesting to me because it actually kind of looks bullish. Now, it can play from either way, but I'll show you something. So this is equal weight Qs. Take a look here. Pay attention to the blue line. Okay, so the blue line, boom, blue line. And now pay attention to the blue little line things that I'm doing here. We have a low, a higher low, a higher low, a higher low. So we have price contracting. It's coiling up here, right? Remember, expansion leads to contraction. Contraction leads to expansion. So what I'm saying here is if we start actually breaking above on equal weight, this thing could get set to rock and roll to the upside, which would be a very positive sign to breadth. And even if the big tech comes off a little bit, hey, we might have an opportunity to play equal weight to the upside. Now, on the flip to that, if this starts breaking down, boom, well, that would hurt even more so this divergence that's currently building. Food for thought. Percent of stocks above the 50-day, 200-day for the S&P 500. Same situation, cracked higher there with the S&P 500. But take a look, man. We're getting pretty darn. Only 32% of the stocks in the S&P 500 are above the 50-day, which means what? 68% of the stocks are below. 68% of the stocks in the S&P 500 are below a 50-day moving average. Okay. On the flip side of that, 41% of stocks are above the 200-day moving average there. When it gets way down into these readings, that typically marks, kind of capitulation levels, right? Both in 200, both in 50. So this would be more areas where you'd be like, hey, I'm covering some stuff out there, or I'm looking to go long, because when we get to these areas, it's pretty extended. Same thing with equal weight on the S&P versus the S&P 500. You can see that this is coming off hard, why we made higher there. So very same situation. A lot of lackluster breadth in the markets. If you look at it from this perspective and these type of indicators, the consumer's getting pinched. However, once again, just to kind of revisit back to the front of the line again, that does not mean the market can't go up higher. Okay, so when we look at the S&P 500, as long as we can hold that quarter to date, we're bullish and the door's open. If we get back below it, the door's back open down to the year-to-date anchored VWAP. That is what it is. If you guys like this type of content, you can always come in the swing trading community for more content. This is only $9 a month or $90 for the entire year. This is where I give some trade ideas, which I'm not giving you. It's not an alert service. So if you think it's an alert service, don't even bother coming. That's not what it is. I just give out multiple charts, a lot of charts, different things that are contracting and cool little setups. I give out a watch list. I kind of revisit that on a weekly, monthly basis. And then I give expected moves on a daily basis, weekly, monthly. And then you get access to the zones. You get access, if you like these stock market charts that I give, you have permalinks there. And then obviously the community there too as well. If I look at the zones, I just want to call out the dollar. It is getting a little frothy, right? Reaching up to the higher end. We talked about that yesterday. About a 0.5% to the upside, 2% to the downside. And then the yield to the 10-year yield's getting a little frothy, about 1.86% upside to the low end, which is about 10% to the downside. Could create an opportunity in bonds if that were to actually come in. Be very careful, because obviously we have the whole debt ceiling thing going on right now. It's right around the corner to June 1st, but there's some data that's out that's saying, she's just bluffing. It actually can go a little bit longer, yada, yada. That's all I got for you on today's episode, everybody. Bye.